Let's talk about the stock market. Now that October is fully underway, I want to talk about, of course, seasonality, but we have a lot of other things brewing. We have political tensions clearly boiling over in the Middle East. We have volatility spiking here in the US because of our own elections. We have the market just coming off of an all-time high. And now, just a little bit of sprinkles on top of this crazy cupcake, the yield curve is once again re-inverting. So just for what in the world's happening in October, what's happening for this week, this is everything you need to know. When we get to this point of the year, a lot of people have a kind of a sour taste in their mouth in October because a lot of bad things have happened in October. But from a seasonality standpoint, October still favors the bulls. Yes, I understand that certain bad things have happened, but all those other years where it's a bit more quiet, there's a general just grind to the upside. October, call it whatever you want, but October, November, and December is actually the most bullish quarter out of the entire year because historically, all 3 months, when you average it out, when you get the median return, does favor the bulls. With that being said, the start of October is a little bit rocky. We have a bit of bullishness at first, then a bit of bearishness, and then about 1/3 of the way through, which is oddly enough where we are right now, it kind of bottoms out, and then that's where it gets its footing. And then November, very bullish with a little bit of bearish around Thanksgiving, and then December, pretty much the whole thing bullish with the middle of it being a little bit choppy. But I do want you to know that yes, the start of October, historically, this is by no means a guarantee, is choppy. But once you get about through the first third, it does clearly start to favor the bulls. Now, obviously, that's a look at all the data we have on the S&P 500. What's probably on your mind is what's happening this time around. Bond traders buckle up for a quote-unquote no landing after jobs surprise. Now, for those of you who might have missed it, last Friday, we got the unemployment report for the month of January. Unemployment was expected to be 4.2%, but it came in at 4.1%, so better than expected. But what was crazy was they were looking for the addition of 150,000 jobs, and that got blown out of the water, came in at 254.
What?
How in the world could they be that far off? Now, I just want to put a little asterisk here, a little bit of a caveat, that most likely this jobs number is going to get revised downward, and most likely this is just some like last ditch effort shenanigans before the election, because what we got on Friday was the final unemployment report we're going to get before the election. So it would make sense to try to make things seem better than they actually are. In the future, they kindly get normally, I should say, not always, but normally they get revised to like more of an expected number. So anyway, I just want to put that out there, but just on that data before it was actually going to get revised, just on what we have right now at the moment that I'm filming this video, the number was sky high to the point that when you look at the yield curve, for those of you who don't know, when people refer to the yield curve, they're looking at the 10-year yield and they're subtracting the 2-year yield. That is the yield curve. It was so strong that we actually dipped back down, and early this morning, we got back under 0%, as in the yield curve might be once again re-inverting, as in going upside down. We're, I guess, in the land of stranger things when we're now living in the upside down. And we were there for actually the longest time we've ever been. Obviously, you can see we kind of got here in July of 22. We were successfully getting back out in September of 24. And a lot of people thought this was interesting. And the reasoning for that is the generic movement here. This is highly correlated with the unemployment report. This line generically shows you what's going on in the labor market. When you're down here, generally the labor market is very hot. And then when you start to spike up, quote unquote, bullish steepening, that actually represents the labor market cooling off, i.e. unemployment going up. And that is historically highly correlated with the stock market getting kicked in the balls, because when you have the unemployment spiking, what do you think happens a couple quarters later when a lot of people are losing their jobs? It makes its way through the economy. Then you start to see that reflected in earnings reports, and then you see it reflected in the stock market. So right now, when we're coming back down, that's actually in the short term bullish. Now, this has happened before where you're like, well, hang on, we were inverted, then we uninverted. Like, does this thing have a fake out? It does. Sometimes there are false signals. I had the most recent 3 in 2006, specifically February. We did pop up, then we came back down, and guess what happened a little bit later? Because it was negative for the second time after the fake out. Then it spiked back up, and then we all know what happened in 08. And then we saw similar things in the summer of 1998 and also the summer of 1989. both of these, or really all three of these, were the most recent 3 times that the yield curve was negative. Then it went to spike up and everyone's like, uh-oh, market's gonna get crushed. And in the short term, it took some hits, but it actually re-inverted, went once again negative, and then we were there for some period of time. And it was on that second attempt back up that, yes, we got back into the positive territory, which was clearly associated with a spike in unemployment. And then the stock market actually took a considerable hit. So what does this mean right here, right now? Yeah, of course we could have a fake out. If it drops, I want to be very clear, in the short term, that would be bullish. In the medium term, that would be bearish. And what I'm saying is when this comes down, that means the labor market is once again hot. And in the short term, that's going to be associated with bullish tendencies in the stock market. But we're not going to stay negative forever. So when the fake out goes back to where it should be, and once again, we're uninverting back in the positive territory, that's going to be associated with a spike in unemployment. And by the time that makes itself through the system, that's where in the medium term, we're going to take most likely some form of a hit. So yes, in the short term, this is key to watch. Are we above or below the 0 line on the yield curve? Now, to add a little bit more context, on Squawk Box this morning, they had a pretty good commentator on it. And I just wanted to share their thoughts and then add a little bit more color, a little bit more context on maybe some of the aspects that don't make the most sense.
Busy week ahead for the markets with inflation data and bank earnings on the agenda. Joining us now is Sylvia Jablonsky, Defiance ETF's co-founder and CEO. Even though we've seen some, I don't know whether you call it anxiety or maybe skepticism about the 50 basis point cut in relation to what that jobs number we saw on Friday. You're taking it at face value, I think, Sylvia. Soft landing, rates coming down, earnings staying strong, inflation under control. It's all a green light for you for stocks?
It's all a green light for now. You know, I think the U.S. job numbers beat expectations on all fronts. Wages looked good. That tells us that the consumer will likely continue to spend, which feeds the economy. You know, the S&P 500 is up about 20% in 2024, which added $8 trillion to market cap. I mean, it's hard to argue that it's a bad year and that a recession is looming. So I think earnings are strong. The Fed has been, favorable to markets, supportive of markets, at least, with the last rate cut, and is projected to be the same depending on data going forward. And I think earnings are looking pretty good. We're expecting 4.7% growth year over year. People are working, jobs are strong, and earnings are good. I think that bodes well for a soft landing and a bull market into the year end. Barring any kind of major issue, which we do have some caveats there with what's going on in the Middle East. We don't know what happens there. But barring, that kind of escalating further beyond what we expect, the market could end up rallying into the year, I think.
I very much agree with that once again, we need to get our time frames right. That if we come back down here, that means that the labor market's going to be good in the short term for the stock market. But we get into an interesting situation where if this happens, that's inflationary. The whole reason we were jacking up the Fed fund rate was to fight inflation. So people are starting to say, we don't want to repeat what happened decades ago where we thought we beat inflation. They took their foot off the throat of the economy by cutting rates too quickly. And then all of a sudden inflation came back. So now in the short term, this could be bullish. But if inflation starts to spike again, we could have a legitimate problem. So everyone's paying attention to the Fed fund rates. Obviously, last month we got the cut. We were at 5.25. We got a 50 bips cut to 4.75. Now people are starting to say, what's going to happen on November 7th? We're at 4.75. Right now, the market is saying, hey, 86% chance of a 25 bips rate cut. But the odds are spiking that we actually might get no rate change at all. Because remember, the Fed doesn't want to undo things so rapidly that we get inflation once again. I wouldn't be surprised if we continue to see a hot labor market and the stock market keeps going up. I wouldn't in any way be surprised to see the odds of no rate cut at the November meeting starting to spike. Now, obviously, the things that could impact that in the short term is the actual inflation reports. So this Thursday, October 10th, CPI report, the consumer price index, and then on Friday, the producer price index, 2 very important measures of inflation. And speaking of the Fed, Wednesday at 2 p.m., we're going to get the FOMC meeting minutes, which is the meeting minutes from that last FOMC meeting. Now, this all doesn't live in a vacuum. There's still many other things going on, such as the fact that the Chinese stock market is rippity skippity doodah to kingdom come, and Goldman actually says it could go about 20% higher. Goldman says surging Chinese stocks may advance another 20%. You might want to believe them. They might be attempting to sell you their bags. I don't know, but craziness is happening in China, worthwhile to pay attention to, and craziness is about to happen here in the US stock market because we're about to start earnings season. This Friday, we're hearing from some of the biggest banks, JP Morgan, Wells Fargo, and then right after that, Citi, PNC, basically the whole banking sector, where we're going to glean a little bit more information of how strong the consumer is or isn't. That's everything you need to pay attention to in the short term this week, and a lot of the key things going on for the remainder of October. But obviously, we have volatility spiking in the stock market because of craziness in the Middle East, the election cycle here in the US, craziness happening with fixed income and the yield curve reinverting. There's a lot going on. Pay attention. As always, stick to your system. Don't bet more than you're willing to lose, and buckle up because we're going on quite a ride.